Now we're going to talk about the sales billing process, okay? What could go wrong in this process? Technically, all the information was taken during the sales ordering process, right? So the company is sending the client or the customer a bill. What mistakes could they make? Invoice them for the wrong price. That could happen. What else? Is that what you're going to say, Brandon? Yeah, pretty much what I would have said. What if they billed the wrong person? That could happen. Just like if you think about it, couldn't that also have been a risk for shipping in terms of shipping to the wrong customer address, right? Notice that whenever you're talking about the wrong address, quantity, items, typically you can kind of interchange those words, right? The control would be similar. It's just instead of checking the shipping documents and comparing it to the sales order for quantity, you compare it for customer address. So the wrong price, yeah, absolutely. It could be because somebody changed it or because they made a mistake or something like that, but it could be the wrong price, yeah. Discounts? Yeah, typically discounts make the prices lower. Is that what you mean? Yeah, it still would result in the wrong price being charged, right? What if they don't even bill the client or customer? Just like in the shipping process, what happens if they don't even ship actually, we probably should talk about that. What happens if they don't even ship the item? Well, technically, should there be revenue on the books? Nope, big deal. But let's talk about it in terms of billing because we're in this cycle. So how could the audit client prevent that risk? How could the audit client prevent not billing the customer? Because that would be a bad thing. Making sure that this is one that typically automation would really help in, right? Because what if the control or if the risk is that the client is or the customer is never billed? How about you build a control in the system that says immediately once the item is shipped, the invoice is generated. Right? That could help that. Absolutely. But let's talk about well, no, I guess it'd be the same if we're talking about shipping. What else could go wrong in this cycle? We said billing to the wrong customer. So, oh no, let's do billing the wrong price. How could that be prevented? Some of you guys might get this particular process on your exam. How could that risk be prevented? Billing the wrong price to a customer. How about prior to the invoice being generated, right? Someone checks the price on the sales order to the one that's on the invoice before they send it. That'll make sure that you get the price right. Yeah, so think about it. How would you know what the correct price is? So here's the deal with absolutely, right? That's easy, no problem. But on your exam, you're asked to give good controls. And what we define that as is controls that don't involve the customer having to do something because they don't work for the company. You can't necessarily, even though they should be interested in making sure their orders are right, doesn't mean they will. And that means that that can't be a good control because it's affected by somebody outside of the personnel, the board of directors, the managers. Remember that was in the definition of internal controls. So yes, they could do that, but it wouldn't be what we call a good control. Because you're counting on what if I didn't get that confirmation or I put in junk mail, then the customer. So when you think about all the risks that could happen in this process, then you think about, well, what could go wrong? Then you think to yourself, how would that be prevented or detected? If the risk is that you don't bill the customer, right? Or the client doesn't bill the customer, how would that be detected? Well, if the risk is that it's never invoiced, somebody could go in the system after, the end of the day, all the sales have been made and produce a report that tells you what's been billed and what haven't, right? And compare that with what's been ordered and see if there's something missing. Yeah, they can do that. The point here, this is one of those exams I told you guys that I would give somebody who is not an accounting or business or student at all to see if they could pass it. And they typically get a B. And the reason they do that is because they can just logically think through it. Like if the risk is that it's never billed, well, then somebody should check to see in the system if there's been a bill generated at some point. If the risk is that someone has shipped to the wrong or shipping the wrong products, well, somebody should compare what was ordered with what's being shipped, right? So don't try to overthink it. If you get stuck on something, try to just logically answer the problem. So let's do this again.